once again Angel Montesclaros from Market Insights Asia Pacific, and welcome back to Forex Trading, the foundation class. On session 3, we will be discussing economic indicators and calendars. So what do we mean when we say economic indicators? An economic indicator is a piece of economic data, usually of macroeconomic scale, that is used by analysts to interpret current or future investment possibilities, or to judge the overall health of an economy. We have three major types of economic indicators: leading, coincident, and lagging. Leading indicators are used to predict the future movements of an economy. From the word leading, before the market moves, the leading indicators are already giving us warning. But the downside is, even though they are advanced, the indicator is not accurate. We have number 2, coincident indicators are seen with the occurrence of specific economic activities. They go in together. If the economy moves, these indicators also move. But the downside is there are very few coincident indicators, so not much that we could observe on this type of indicators. Lastly, we have lagging indicators that are only seen after specific economic activity occurs. Although they are late or they are lagging, they are more accurate or the most accurate among the three, because the market already moves or the economy already moves. It just records that movement. Okay. Now that we know the three types of economic indicators, let us discuss the 10 commonly used or most popular economic indicators out there. Starting off, we have the gross domestic product or GDP. It is the broadest measure of the overall health of the economy. It is defined as the total value of all products manufactured and goods provided within the territory during a specified period of time. Don't be confused with gross national product. Okay, how do we differentiate the two? GDP is the totality of everything: products manufactured, services provided within the territory. So in a specific country, there are two types of people: the locals and foreigners. Whether the product or the service is provided by a local or a foreigner, as long as it is done within the country, that is gross domestic product. On the other hand, gross national product are the totality of products and services done by the people of the country. So it accounts for products and services done by, for example, here in the Philippines, Filipinos here in the Philippines, and Filipinos working abroad. We don't care about gross national product in Forex. We only care about GDP. So how does the GDP impacts Forex trading or the market? It takes a long time for the GDP to have a direct impact on Forex market. But despite its lack of timeliness, it is the single best measure used to confirm where a country stands in the business cycle. The business cycle I will be explaining next episode, so stay tuned. As a warning, the definition here and the impact is not from me. Also, the screenshot is not from me. I took it from forexfactory.com. I will show you where to find all of these on the latter part of the video. But let's just focus on the screenshot first. This is how GDP looks like under forexfactory.com. There are other websites that shows you the economic indicators and calendars. I just prefer to use Forex Factory because it's cleaner, beginner-friendly economic calendar. GBP is it shows you the currency where this data has impact on. GBP is the currency of United Kingdom. Red is the data impact. Red is high impact data. If it's orange, it's a medium impact data, and if it's yellow, it's a low impact data. This is GDP so GDP on a monthly basis. There's another GDP over here, which is GDP QQ or quarterly. As a general note, if it just says GDP, that means it's a monthly data. If it has time here, then just focus on whatever time frame is stated here. But if it's just GDP alone, again, that is a monthly data. We have here three sets of numbers. The rightmost corner, the leftmost one, and the middle one. The one on the right, which is 0.4%, this is the previous data. Since this is a monthly data, this is the data last month. Now, as mentioned, GDP is a lagging data. So this is during recording, the month is September. Therefore, this GDP cannot be the September GDP. Why? Because it's still September. It's still on the middle of September. September has to end first before GDP will be computed. Therefore, if right now is September, this data is showing you the GDP for the month of August. Again, this is not the actual data for September. I'm just assuming if this data was released on September, assuming the data was released on September, this is referring to the GDP last August. And 0.4% over here is showing you the GDP for the month of July. The one in the middle is a forecast. So for the month of August, we are forecasting that the GDP will slow down to negative 1.2%. This is the comparison where last month, this is a month-on-month data. We're not showing you the nominal value of the GDP, but rather the the change in percentage. And then the actual data is negative 0.6%. Why is this in green? A red data indicates that it is worse or a bad data. A black data here, black in color, is a neutral or no change at all. And the green one is a good data or there is a positive change seen. Even though this is negative 0.6%, it's still considered as positive. Why? Because negative 0.6% is better than the forecast. For forexfactory.com, the color of the actual depends on the forecast. If the actual is better than the forecast, this will be green. If the actual is worse than the forecast, this would be red. If the actual is the same as forecast, this will be in black color. Simultaneously, there is another GDP over here, which is Prelim Gdp QQ or Preliminary GDP Quarterly. Now, some countries, they have GDP only. Some countries, they have Prelim GDP and Final GDP. Prelim GDP is also known as Advanced GDP. So we are still on the quarter, but there is already an advanced GDP. The final GDP would be announced after the quarter has ended. That would be your final GDP. Again, negative 0.1% is better than negative 0.2%. So this is green in color. Number 2, we have the non-farm payroll NFP or the non-farm employment change. Even though the names are different, this is actually the same data. It refers to the totality of all employment generated within the country, with the exception of the farming industry. It also excludes unincorporated self-employment and employment by private households, non-profit organizations, and the military and intelligence agencies. Proprietors are also excluded. Why are these people excluded on the employment change? In the US, they are using NFP to determine if the economy is growing or not. If the country is generating more employment, that means that they are growing. If employment generated is contracting, then the economy is contracting as well. But this is true to all countries. Whether we are on a recession or whether the economy is seeing growth, there would always be jobs within the farming industry. We all need to eat. That's the bottom line. No one can survive without food and without the farming industry. Therefore, it does not really show you growth indication of growth. Same with let's say military and intelligence agencies. It doesn't show you anything related to the economy. That's why they are not included on the list. But in other countries, they don't have NFP. What they have is the employment change. What's the difference? NFP, simple, farming not included on the employment change. Employment change, on the other hand, shows you the number of jobs created or number of jobs lost. Doesn't matter what industry it is. That's your simple employment change. Most countries, they have employment change, but there are very few countries like in the US that they have non-farm employment change. But take note, US does not have employment change. They only have NFP. So what's the impact of NFP on the market? Job creation is an important leading indicator of consumer spending. Consumer spending, which can be used as a guide to forecast GDP. Here. For example, I am a business owner. I have my own sentiment on the market. If I am thinking that the market would be great, I would be hiring more people. I want to be able to meet the demand of the market. And if I hire more people, I will be paying these people. They're not gonna work for me for free. So their salary would result to consumer spending. If we account for every consumer spending, that's gonna be your GDP. Simple, right? So NFP is a leading indicator of GDP. Now, take a look at the example here. Another screenshot from forexfactory.com. 398,000 was the job generated last month. Again, if this was the September data, 528,000 was the job created last August, and 398,000 shows the job created for the month of July. 250K is the forecast. So, comparing the actual versus the forecast and the previous, it is still better, no doubt. This is a positive news for the US dollar. There are times when the NFP is negative. That means instead of generating new jobs, they actually lost jobs. But in general, as long as the NFP is around the 100,000 mark, it shows that the economy of the US is still growing. So 528,000 is a very good number. Moving on, we have number 3, unemployment rate. It is defined as the percentage of the labor force actively looking for work. Unemployed people are those who report that they are without work, they are available for work, and they have taken steps to find work. It should require, or someone should meet these 3 requirements before they could be considered unemployed people. So if you're a lazy bum who likes to stay at home, do nothing, ask money from someone else, and you're not actually trying to do anything to find or land a job, then you're not considered as unemployed people on this indicator. Technically, you are unemployed, but you're not counted on this data. This is a lagging indicator. Why? I'm assuming again that this was September data. It shows you the unemployment rate for the month of August, right? But when you filed for unemployment, meaning you are already unemployed, you already lost your job. You're not about to lose your job, you already lost it. That's why you're letting the government know that you are unemployed. It cannot be done in advance. You cannot be reporting in advance. Some people would be wondering, why are they reporting that they are unemployed? How come the government knows about this one? In some countries, they are giving away unemployment package or benefit to those people who lost their job. In my country, that's not possible. If you don't have a job, you lost a job, you don't get paid. No work, no pay, that's it. You don't get anything from the government. Not even a smiley face or a cake or whatever, nothing. Nada, zero. But in some countries, for example, I have friends in South Korea, the first 6 months that you are unemployed, you get a unemployment benefit. I'm not sure if I think the last time I heard it's like around $800 on a monthly basis. For you to get this benefit, you have to report that you are already unemployed. Unemployment rate is important because these people, or if you are unemployed, you don't have money to spend. You don't have a job, right? No job, no money. No money, no consumer spending. No consumer spending would mean lower gross domestic product, right? For this example, 3.6% is the forecast and previous data. And the actual is 3.5%. Other data that we are discussing, the higher the better. But for unemployment rate, it should be the lower the better. There we go. Next, interest rates. I have already discussed this on the previous session. This is just a short recap. It is the rate at which a nation's central bank lends money to domestic banks. This is usually the rate commercial banks use to determine deposit and loans rate they offer to their consumers. Impact. Traders look at the interest rate differentials of two currencies to weigh in its valuation. Changes in interest rates are usually priced into the market, so it tends to be overshadowed by the rate statement, which is focused on future actions of the central bank. That's too long. Let's break it down into two sentences. Let's take a look at the first sentence first. Traders look at interest rate differentials of two currencies to weigh in its valuation. Most people, you only have one type of account, the account in your local currency. Most Filipinos only have Philippine bank accounts. Bank accounts in Philippine peso, right? But some people, especially if you're a huge business, huge corporations, or you're just an investor, or you have so much money, you have bank accounts in different currencies. So personally, I have two accounts. I have a dollar account and I have a peso account. Now, if, for example, my peso account is paying me 1% to save my money in peso, and my US dollar account is paying me 2%, where should I put my money? No brainer, right? I would put it on the US dollar account. Therefore, my US dollar has more value in comparison to my Philippine peso. Should I keep my Philippine peso? We're talking about savings here, right? Should I keep it? Nah. I would convert it into US dollar because it's giving me more interest rates, more savings interest rates. Another one, changes in the interest rates are usually priced in, so people are looking forward towards the rate statement. How does it go? Each central bank has a schedule. For example, the Federal Open Market Committee, or FOMC, they meet 8 times a year. And it is already scheduled way ahead for the year. When the time comes that they are scheduled to announce the cash rate, or the FOMC federal funds rate, it comes in with a rate statement. The rate statement is a summary in words why they decided to change the interest rate or not change the interest rate, what they saw on the market, and what they are seeing on the market. So it's talking about the past, the present, and the future. The past is not tradable anymore. It's done. The present could be traded if there is a change on the interest rate. Given that there's no change on the interest rate, or the interest rate there is a change on the interest rate, but it is the same as forecast, then there's no movement already there. The movement would be coming from the future of the currency, or what is the central bank seeing on the future. That's why the rate statement usually bears more impact upon its release, of course. On this example, this is the RBA cash rate. 1.35% is the previous. Forecast is 1.85%. So everyone is agreeing there is an increase on interest rates from the RBA. When the RBA announced that it is indeed 1.85%, would there be any movement? I don't think so. Why? If the forecast is 1.85, why should I be waiting for the RBA to announce it before I make any trade? I could gamble and trade already in advance, right? So when the RBA announced, okay, it's 1.85%, me who traded in advance, should I be entering the market again? Should I be opening a new trade? No, I'm not. What I'm gonna do is to close my trade. That's why it's called priced in already. Traders already traded in advance. And when a certain event is already priced in and the actual is the same as forecast, would be seeing an increase here? No, we're gonna see a small dip there. The dip would be coming from people taking their profits. Now, where would the direction be? The direction would be on the rate, The direction would be on the rate statement. So if the RBA, for example, is seeing that the Australian economy would be better off in the next coming months, then AUD would dip down a bit and then go up again. But if the RBA is seeing, there could be a problem in the next coming months, then the dip would continue. Number 5, Consumer Price Index or CPI. It tracks the prices of a specified set of consumer goods and services, providing a measure of inflation. In other words, this is the inflation that consumers like you and I feels. CPI accounts for majority of the total inflation. Inflation is important in determining currency valuation because when the prices of goods and services rises, the central bank reacts by raising the interest rates. And higher interest rate means more value to the currency, correct? So let's take a look at the CPI down here. There are two kinds of CPI. CPI headline or just plainly CPI and the core CPI. Both of them are red in color, but take a dive. CPI here, month on month, 1.3% was the data previously. Therefore, if this is referring to the September CPI, this was the inflation last July and forecasted to be around 0.2% in August. The actual inflation is 0.0, meaning there is no change in the prices of consumer goods and services on the month of August and July. From July to August, there's no change. Core CPI, on the other hand, is essential goods and services that we consumers spends on. CPI, plain headline CPI, is everything. Core CPI are the essential ones. Now, the central bank is the one determining what are the essential goods and services that would be included on the computation. The details on the basket of goods and services could be different from one country to another. But that's not for us to think of right now. For the core CPI, the previous data was 0.7%. So this was CPI for the month of July. It's forecasted to be at 0.5% for the month of August, and the actual is 0.3%. Why is it that the CPI is still red despite it being 0.3? Because the actual is worse than the forecast. Still, if you take a look at it, it still grew 0.3% higher this month. Therefore, the essential goods and services that we are consuming rises 0.3% from July to August. But there are no visible change on the price of on general or the headline CPI. Next, number 6, we have here the Consumer Price Index or PPI. It measures the change in selling prices received by domestic producers of goods and services, aka inflation felt by producers. Consumers and producers, we buy different things, right? We are not buying tons and tons and tons of rugby or paper or whatever they are using in production. We just buy it as it is when it's already done. and we don't even buy in bulk. But usually, PPI, when the prices for producer goods and services are rising, we typically feel it as prices that were, the consumer goods and services that we're paying for also increases. Because the producers will pass on to the consumers the change in production cost. They're not doing charity there. They're doing businesses there. So if they're selling something, for example, they are selling leather bags and the price for leather increased, the price for the leather bags that they're selling to us would also increase. I'm not sure if it's legal in all countries. I think some countries it's illegal, but here in the Philippines, some manufacturers instead of raising the prices for their products and services, they would just reduce the number in quantity. But technically speaking, they should be raising the prices instead of reducing the quantity, because there would be a perception that you're actually not paying for any increase, or you're paying for less, but in reality you're paying for more. Taking a look here on the screenshot, there is a headline PPI, which is just plainly PPI here, and a core PPI again, headline PPI and essential PPI. Baskets of goods and services counted here depends on what the central bank mandates. Either way, both of them are red in color, meaning there is a reduction or the actual is worse than forecast. Previous PPI is 1.1%, forecast is 0.2%, so people are expecting that the PPI would increase by 0.2%, but instead, it is negative 0.5%. How do we go around this? For the month of July, prices for the producers increased by 1.1%. But instead of increasing this month, for the month of August, it actually was reduced to it was actually 0.5% less than what it was the month of July. For the core PPI, there was actually an increase observed. It was 0.2% increase versus 0.4% forecasted. Even though there is an increase that happened, it is below the forecast, so this is red in color. But still, this is a positive figure. Therefore, the core PPI still increased from month to month, from July to August. Next, we have number 7, industrial production. It is the measure of output in the industrial sector. The industrial sector includes manufacturing, mining, and utilities. This is a leading indicator of economic health. This data reacts quickly to the movement in the business cycle. The business cycle, on the other hand, is related to consumer employment and earnings level. Please take note that the impact of industrial production depends on country to country. For example, this data is important to China because China is an industrial country. Same with Japan. But European area or the Euro area, you could see it's yellow in color. So it's a low impact data because the European market is not really heavily dependent on the industrial sector. Okay? Countries such as US, since there's only one country in US, which is US, you only see one data. But within the Euro area, there are several, or they have a lot of state members or member states within the Euro area. Therefore, there are multiple versions of data. Each country has their own data. How do we analyze this kind of data? For the Euro area, there are 3 major economies: the German area, or Germany, France, and Italy. These 3 are the biggest economy out of all the member states, and we only pay attention to these 3 countries. Therefore, we have German, French, and Italian industrial production over here. And then finally, we have the industrial production, just industrial production. This refers to the industrial production for the entire Euro area. I say Euro area, not Europe, because not all countries in Europe is a member of the European Union. Now, if you're trading Euro, and you have seen a lot of data over here, you'd probably think, oh, I should be probably looking at the final one because it shows you everything. But to be honest, it's not. If you're trading Euro, you should be paying more attention to Germany because Germany is the biggest economy out of all. And mind you, they are accounted for a big percentage of the entire European Union economy. And it says here that previously, the industrial production is negative 0.1. The forecast is negative 0.4, which means that they are expecting they are expecting that the industrial production would be lower, but the actual is 0.4. It actually grew, which is a good story. Industrial production is on a negative, much lower than the forecast. Overall, positive industrial production. This is a good news for Euro. But then again, not so much. Why? Because this is a low impact data for Euro. Number 8, we have retail sales. So retail sales is the number of total receipts of retail stores. Most of us are consumers, and consumers buys from retail stores. So this report gives an early estimate of the nominal dollar value in sales in the retail sector and also reports the number as percentage change from the previous month. We don't care about the nominal value, we only care about the change in percentage. Okay? It is a gauge of consumer spending, which accounts for the majority of overall economic activity. When retail sales goes up, it signifies stronger consumer confidence and spending. If you're thinking you're gonna be unemployed for the next month, you're not gonna spend this month, right? But if you're thinking, next month or the next coming months, my job would be stable, I'm thinking the economy would be stable, your spending would also be as is or stable. It can forecast GDP. All right, so for here, I have a screenshot of the retail sales for China. CNY is for China. And this is a year-on-year retail sales. Meaning, if it was released in 2022, this was the retail sales for the year of 2021. 3.1% is the retail sales for 2020. It was forecasted to be 5% higher for 2021 and the actual is 2.7%. Although there is an increase in retail sales observed, it is way below than the forecast. Therefore, a bad story for the Chinese yuan. Lastly, number 9, second to the last. Purchasing Managers Index or PMI. It is the indicator of the economic health of the manufacturing sector. It has 3 variants: manufacturing, non-manufacturing, and services PMI. But actually, the variants, it depends on the country. Some countries, they only have 2, manufacturing and non-manufacturing PMI, very easy to compare. Some countries, they have 3. The UK even have a construction PMI. So the definition or the scope included on each category or each variant will be depending on the central bank or the government of that country. So if you want to know more about that, you should be researching about that specific country. How do they categorize these variants over here? So impact. PMI is a leading indicator of economic health. Businesses usually react faster to changing market conditions, and their purchasing managers or PMs perhaps holds the most relevant insight into the company's view of the economy. How does this indicator calculated? For example, I work as a purchasing manager for a shoe company. So this month is September and I am forecasting that we're gonna sell out 50 million pairs of shoes. on December. Still on the month of September, I will be buying already the materials, and we should be producing already the shoes that I am predicting we're gonna sell out in the month of December. So, have I already sold the shoes? The shoes? No, not yet. But we already purchased the number of materials that we're gonna use in relation to the forecasted number of sales in December. Why is that a leading indicator? Because the survey is done in September, but the sale would be on December. You don't buy your materials and produce it on the month that you're thinking you're gonna sell it out. You should be doing it in advance so you would be able to meet the demand of the market. For this one, this is an ISM manufacturing PMI. What is the difference? On the earlier sample, it shows you the name of the country, right? We have Spanish, Italian version, French version, German version. That's for Euro area. For this example, ISM is a private company. It's not, this data did not come from the government or the central bank. It's a private company computing for the manufacturing PMI. Therefore, it is called a ISM manufacturing PMI. If you are actually trading US dollar, you would see that NFP, it has a private version. It's called ADP NFP. Why is it ADP NFP? It's a non-farm payroll computed by a company called ADP. Right. So, on this example, previous is 53, forecast is 52.3, and the actual is 52.8. Still better than the forecast, but worse, a little bit worse than the previous. Now, if the PMI is below 50, then the country could be experiencing recession or is on the way to recession. If a country is experiencing growth, you would see this around 60 or higher. So 52.8 is a little bit there, but not so there. It's okay, but it's not a stellar data. Lastly, we have the crude oil inventory. It is the measure in the number of change of barrels of commercial crude oil. This is a weekly data. Here in the Philippines, GMT +8, it is released every Wednesday, 12 midnight. Now, you could adjust your time accordingly to know what time in your country is the crude oil inventory released. Impact. Although this is a US data, it affects Canadian dollar the most because Canada has a huge energy sector. The changes in the prices of petroleum products affects inflation because of the reliance of many industries on oil. So previously, before all of this inflation fiasco happened, this is how I analyzed crude oil. High supply is equals to lower price per barrel. There's so many oil out there. The price would be lower. Lower price per barrel would mean lower income for Canada. And lower income for Canada, weaker Canadian dollar. On the other hand, if there is a low supply of oil, prices per barrel is higher income for Canada and stronger Canadian dollar. But right now, what I'm using this indicator for, or how I'm using this indicator is like this. High supply of oil, meaning there could be a lower price per barrel. And lower price of gasoline or oil products will result to lower inflation. Lower inflation is equals to less chance for an interest rate hike or in some cases even reduction of interest rates depending on where the year-on-year CPI or interest or year-on-year inflation is at. On the flip side, a low supply could result to higher price per barrel, higher oil prices, higher inflation, and higher inflation is a stronger argument for interest rate hike. Let's go back to the All right, let's go back to the sample here. This is a weekly data, and this means that last week there was a negative 4.5 million barrels on the inventory. There was less supply on the market. The forecast is around negative 1.4 million barrels, so they're thinking the deficit would be less than it was last week. The actual is 4.5 million barrels, meaning instead of a deficit, there is an actual surplus of oil on the market, which is 4.5%. The more supply it is on the market, the lower the price per barrel. Alright, that's why it's red. If you have no further questions for the definition of the economic indicators, let's move on to economic calendars. This is forexfactory.com. It's an economic calendar, and this is where I took the screenshots and definitions that I used earlier. How do we use this one? First things first, when you go to this website, is you have to click this and adjust it to your local time. You could pick your time over here, or you could click on synchronize over here. It's already in sync with my computer, so there's no need for me to click here. But if it's not in sync with your device time, that you would see here a button to sync it. Once it's done, just go back to home, and you would see the data scheduled for today. That's the default. If you want to see schedules before or schedules ahead, you could change the date here, change also here, like last week, last month, this week, this month, or next week, next month. But the rule is for forexfactory.com, you could only take a look 60 days within the range. So if I wanted to take a look, for example, August, until I can go back as much as June 1st, something like that, and then apply setting. There is a 60-day max range. If you want to see more, then just adjust the date. Anyway, let's go back to this week. I want to see what's the data for this week, so I just click on this week and apply settings. Right now, these are what's scheduled in for this week. And there is an option here to filter what I wanted to see. I could filter in the impact. So red for high impact data, medium impact data, yellow impact data, and bank holidays is for gray. And then you could also choose in the event type, what kind of data would you like to see? Would you like to see growth data, inflation data, consumer surveys, whatever data you want to see here, and currencies over here. You could untick and just pick one, or you could pick everything. Let's say I wanted to see only the high impact ones. Click on apply folder, and it will only show me the high impact data. So this is very easy to use. Aside from the filter, there is an option here. For example, here under details, there is a folder over here. When you click on the folder, for example here, you would see the definition, what CPI means. How do we use CPI for trading? The previous data here, and some related news stories here. This is actually where I took the definition earlier. If you wanted to see the data, but instead of numbers, you wanted to see it in the chart version, you just click here. This website or this calendar is very beginner friendly. It's not confusing at all. There's color coding in there, and it only shows you the major currency pairs. Great, right? Aside from that, when you click on a data, it already leads you to the news here. So there's no need for you to be roaming around elsewhere looking for related news or related stories. It's already in there. There is another website that you could use, which is investing.com. Also has their own economic calendar. I think this is more suitable for advanced traders simply because when you take a look at the filters, you could actually choose um here. You could actually choose more countries. So if you're trading exotic pairs, you want to see their data, it's easy to access it here. The only reason why I don't really recommend investing.com to beginners is because I feel like it's cluttered. See, so many in here. You could see charts over here. The stars is cluttered. Instead of just having one folder with different colors, I see so many stars in here. There is a country code and a flag over here. Again, too crowded, too cluttered on my opinion. But that's just me. But if you're an advanced trader and wanted to trade exotic pairs, this is perfect because everything is here. Now that we have discussed economic indicators and calendar, let's go ahead on the activity for this session. For activity number 4, again, we already did activity 1, 2, 3 on the previous sessions. The activity numbers are actually in line with each other. Activity number 4, the direction is to match the economic indicator on the left to its definition on the right, right? You could pause this video if you want, or if you are already done with the activity and you wanted to answer with me, you may go ahead and proceed. In 3, 2, 1, let's answer it together. Number 1, crude oil inventory. This is letter D. It is the measure of change in the number of barrels of commercial crude oil. Number 2, consumer price index or CPI. Letter C. It tracks the prices of a specified set of consumer goods and services, providing a measure of inflation. Number 3, Purchasing Managers Index or PMI. Letter E. It is the indicator of the economic health using purchasing surveys. Number 4, Interest rates. Letter F. It is the rate at which a nation's central bank lends money to domestic banks. Number 5, Gross Domestic Product or GDP. Letter A. It is defined as the total value of all products manufactured and goods provided within that territory during a specified period. Number 6, non-farm payroll or non-farm employment change. Letter B. It refers to the totality of all employment generated within the country with the exception of the farming industry. Number 7, Producer Price Index. Letter H. It is the measure of the change in selling prices received by domestic producer of goods and services. Number 8, Unemployment Rate. Letter J. It is defined as the percentage of the labor force actively looking for work but are not yet employed. Number 9, Industrial Production. Letter I. It is a measure of output of the industrial sector of the economy. And number 10, retail sales. Letter G. It is the measure of the total receipts of retail stores. Now that you're familiar with the definition of each indicator, let's take a look at how do we analyze if they are released together. So for number 1, this is a USD data. So these are all labor market data. So this is for this is for June 2022, 8:30 p.m. Average hourly earnings is 0.3% versus 0.4% forecast versus 0.3% previews. There is an increase in the average hourly earnings by 0.3%, but this is less than what is forecasted. That's why it's red in color. Non-farm employment change is 390,000 versus 325,000 forecasted versus 436,000 previous month. Although 390,000 is smaller in number comparison to the number of jobs created last month, this is still a very good data. It means they have generated 390,000 new jobs. And this is better than the forecast. Unemployment rate, however, is 3.6%, expected to be less at around 3.5%, but the actual is the same at 3.6%. So This is red in color. If we're analyzing them together, we don't analyze them one by one. Instead, what we should be looking at is the answer to this question. What data is the central bank looking at? In this case, this is a USD data. So what is the data, or what is the issue the Federal Reserve System, or Fed, is more concerned about? And right now, that is what? Inflation. Therefore, among these three indicators, which one of them pertains to inflation? Average hourly earnings is an inflation data. If people are earning more, they could pay more for services and products that they need. Therefore, an inflation data. Out of these three, the most important one is here. As of the moment, because the central bank is focused on inflation. Although 0.3% is less than what is forecasted, this is still 0.3% increase in comparison last month. So inflation would still, what? Could still go up. Is it a positive or a negative data? This is a positive data. Hey, why is it a positive data? Inflation is rising. Why is it positive? It's positive because we are traders. We're trading based on interest rates, based on the value of currency. Exclude the thinking that you are a consumer. Let's not think that way. Let's only think about you as a Forex trader. Number 2, this is another US data about simultaneously released together ISM manufacturing PMI and JOLTS job openings. Both of them are positive, better than forecasted. And the manufacturing PMI is even better than previous. So no question about it, this is a positive data. Number 3, this is a Canadian employment data. They are released together. Employment change and unemployment rate, since both of them are high impact data and capacity utilization rate is a low impact data, we could disregard this one and just focus on the two. And both of them are what? Better than forecast and preview. So no doubt this is a good story for Canadian dollar. Number 4, both US data, retail sales. One headline retail sales and one core retail sales. Both of them are red in color, meaning the actual is worse than the forecast. But let's take a look at the previous one. The previous is 0.4%, the actual is 0.5%, meaning the core retail sale still increased by 0.5% in comparison to last month. Although it is short than the forecast, it's still an increase nonetheless. The retail sales, or the headline retail sales, is actually negative. Therefore, instead of the prices rising, there is an observed decline in the prices. How much is the decline? Negative 0.3%. Therefore, what kind of a data is this? It is a positive or a negative data? This is what? This is a negative data. Why is it a negative data? Retail sales is one of the leading consumer spending data. If people are spending less on consumer sales, meaning CPI could be less. Less CPI is equals to lower chance of interest rate hike or even a reduction on interest rate hike. So this is a negative story. And lastly, we have number 5 here, a euro data. Now, this is quite confusing because there's so many indicators out there, but again, if we are taking a look at euro data, we should be paying attention to what country? Germany. The others are also low impact data. Therefore, we can ignore this one and just focus on the red one or the high impact one, which is German data. Both of them are lower than forecast and lower than previous. For the summary, an economic indicator is a piece of economic data, usually of macroeconomic scale, that is used by analysts to interpret current or future investment possibilities or to judge overall health of the economy. There are three types of economic indicators: leading, lagging, and coincident. Leading indicators are used to predict future movement of an economy. Although they are leading, they are not that accurate. Coincident indicators are seen with the occurrence of specific economic activities, while lagging indicators are only seen after specific economic activity occurs, but they are accurate. The following are the commonly used economic indicators. First is the gross domestic product, or GDP, which is defined as the total value of all products manufactured and goods provided within that territory during a specified period of time. Number two, non-farm payroll, or NFP, or non-farm employment change. It refers to the totality of all employment generated within the country with the exception of the farming industry. Third, unemployment rate. It is defined as a percentage of the labor force actively looking for work. If you're a lazy bum who has no intention of finding a job, you're not counted on the unemployment rate. Fourth, interest rate is the rate at which a nation's central bank lends money to domestic banks. Out of all the data, this is probably the most important one. Next, CPI, or Consumer Price Index. It tracks the prices of a specified set of goods and services, providing a measure of inflation, aka inflation that can be felt by consumers like you and I. Producer Price Index, or PPI, or producer inflation, is a measure of the change in selling prices received by domestic producers of goods and services. Industrial production, on the other hand, is the measure of output of the industrial sector of the economy. Retail sales is the measure of the total receipts of retail stores. Number 9, Purchasing Managers Index, or PMI, is the indicator of economic health of the manufacturing sector. And lastly, number 10, Crude Oil Inventory is the measure of change in the number of barrels of commercial crude oil. This concludes session 3, Economic Indicators and Calendars. Again, if you have questions or comments, please feel free to leave a comment down below. And don't forget to like and share our Facebook, YouTube, and TikTok page on Market Insights Asia Pacific. On the next session, we will be discussing business cycle, or economic cycle, and monetary policy. I hope to see you on the next episode. Bye-bye!